Hello, everyone. This is Chris Verrone, head of technical and macro research at Strategas, the investment strategy arm of Baird. As always, it is a pleasure to be with you and to share our views on markets. There are five quick topics I want to touch on in today's video. Number one, we'll revisit this idea of unique crisis, ordinary market. Second, I want to touch on what our sentiment data is telling us. Third, we'll try to answer the question of why we don't think this is 1999. Fourth, we'll look at the message from our sector rankings. And then lastly, I want to highlight a part of the world that we think is acting a lot better than the consensus gives it credit for. But where to begin today? Revisiting this theme that's been so dominant in our work over the last 12 months of unique crisis, ordinary market. And it really speaks to the idea that while COVID was certainly a unique crisis, every crisis is equally as unique. Subprime was unique, the tech bubble was unique, LTCM was unique. What's not particularly unique is the market's interpretation of all these events. And I think it's why historically, if you look at the performance the first 12 months off the low, it is so historically familiar. You tend to get some of your best bull market returns in those first 12 months off the bottom. In the most recent example, up 75% off the March 23rd, 2020 low. And there's something disorienting about this because it's that first 12 months off the low where there's this great divide between what the equity market reflects and what the economy reflects. That divergence was not unique to COVID. We see that historically over time. So I bring this up today because it's now April of 2021. We're more than a year off last year's low. And when you look at performance in that second year off of a market bottom, returns are still pretty good, averaging roughly 13%. But I think the bigger takeaway is it's rarely a straight line in that second year off of a market bottom. You do tend to get a drawdown or a correction in year two off of a low. And I just want to be a little bit mindful of this for two reasons. Number one, we are starting to approach the weaker seasonal period of the year. By about mid-July, you begin to lose the support of the calendar. And secondly, and maybe most important right now, some of our sentiment data is starting to run pretty hot. We look at about 7 different sentiment inputs every single day. Things like flows and surveys, put calls. 5 of them right now are in at least the 90th percentile of the historical range. This tells us that the bar to exceed expectations is getting higher and higher. And that, I think, is another big difference between year one off the low and year two off the low. Expectations tend to be very depressed the first year off of a market bottom. It gets harder to beat upward expectations year two off a low. So just something we want to be a little bit mindful of as we approach the summer. Now, I think the good news is this market is still really, really broad. Something like 96% of the S&P is still above the 200-day moving average. We like to call this, quote, a good overbought condition. When participation is this broad, you really don't tend to get major tops from this condition. You can get corrections or consolidations, but your major tops historically often come from very, very narrow markets, and that's just not the case today. And I think comparing this to the 1999-2000 period really speaks to the difference between what the market looked like then and what the market looks like today. And it's one of the reasons why we don't really buy the 99 comp. March 24th of 2000 was the all-time high of the S&P tech cycle. There were only 35% of stocks above the 200-day moving average. Half of the market, 2/3 of the market had already broken down. That was a very, very narrow advance, vulnerable to something going wrong. Very different picture than what we see today. I also think it's notable that our sector and our credit work remains very, very benign. Double B spreads remain at their lows. I think if something truly sinister was brewing, we'd start to see it in credit. We don't see it yet. And looking at our sector rankings, it stands out to us that the market's more defensive groups, healthcare, staples, utilities, remain at the bottom of this list. Again, I think if something truly sinister was brewing on the horizon, we'd start to see the defensive sectors make their way up this list. We just haven't seen it yet. The top of our sector rankings is still largely defined by the market's more cyclical corners. I think in particular, when you look at consumer discretionary outperforming is an early cycle phenomena. So as long as we have discretionary working, I still feel comfortable that we're early to mid in this market cycle. And within discretionary, a big focus of our work recently has been the strength from the home builders. This is the S&P Home Building Index over the last 20 years. Despite how big and abrupt the move has been off the COVID lows, I want you to keep in mind the home builders are only just back to where they were in 2004, 2005. You had 15 years of nothing here. These stocks are finally starting to break out on their own right, and they're breaking out relative to the S&P. I think the leadership coming from the home building names is a very, very positive event for the broader consumer discretionary sector. The last thing we just want to touch on in today's video is a part of the world that we think is acting a lot better than the consensus gives it credit for, and that's Europe. The headlines on Europe, this is from last week's Economist, have been very, very pessimistic about the fallout from the vaccine rollout. But when we look at the price action, it tells a very different story. German DAX is at an all-time high. The French CAC is right there as well. Italian stocks have acted well. UK acting better. So I think broadly, we like to look for areas of the world where the price action defies the consensus thinking. I think Europe is a great example. That's what we have today. As always, thank you for your time and hope to speak with you soon.